In 2000, Masayoshi Son lost $70 billion in the dot-com crash, the largest personal financial wipeout in human history. Yet 17 years later, he convinced the Crown Prince of Saudi Arabia to hand him $45 billion after a 45-minute meeting to do it all over again. How did the man who suffered the worst financial wipeout in history convince the world's most powerful investors to hand him $100 billion to build an even deadlier tech bubble? What did he see that the rest of Wall Street missed? Or was it all just an illusion? A barefoot founder drinking tequila in New York was about to receive $4.4 billion after a brief office tour. He did not know that his company's valuation was a ticking bomb. A hidden 7% interest rate on billions of dollars of Middle Eastern wealth threatened to drag down the entire venture capital landscape. We will expose exactly how this secret term sheet doomed the fund. By late 2023, the record books would record a devastating $32 billion loss, forcing the tech kingmaker into a tearful retreat. Let us begin where the hubris was born. To understand the sheer scale of the Vision Fund, you have to go back to Japan in the late 1990s. Masayoshi Son was not just a businessman. He was a software distributor who saw the internet as an absolute religion. He built SoftBank into a telecom powerhouse, but his real genius lay in investing. In 1999, his net worth was rising by $1 billion a week, making him briefly richer than Bill Gates. Then the dot-com bubble burst. Within months, SoftBank stock crashed by 99%, vaporizing $70 billion of his personal wealth and leaving his empire on the brink of complete annihilation. Any normal human would have retired, broken and cautious. But Masa was not normal. He possessed an absolute messianic belief that his gut instinct could defy basic financial gravity. Why was he so confident? Because of a single legendary trade he made in the year 2000 that would define his entire career and give him an unbreakable god complex. He had met a young, unknown Chinese entrepreneur named Jack Ma, who was running an obscure e-commerce startup out of a cramped apartment in Hangzhou. Masa listened to Ma pitch for just 6 minutes before cutting him off. He did not look at a business plan or revenue figures. He simply looked into the young man's eyes. Masa said, "I will invest $20 million. Jack Ma tried to refuse so much money, but Masa insisted, demanding Ma take the cash to build something massive. 14 years later, in September 2014, Alibaba went public on the New York Stock Exchange in the largest IPO in history. Masa's $20 million stake was suddenly worth $60 billion. He had turned a minor bet into a 3,000-fold return. It was a trade so legendary that it erased all memories of his $70 billion disaster, giving him the reputation of a financial prophet. But this spectacular win carried a deep, invisible danger. It convinced Masa that his gut was infallible, that traditional due diligence was for cowards, and that more money always solved the problem. If you want to know how empires leverage massive bets, Built and Broken uncovers a new corporate rise and fall every week. Hit subscribe to join our deep dives into the minds of the world's most reckless builders. By 2016, Masa realized that traditional venture capital was too slow and too small. The biggest funds in Silicon Valley were raising $1 billion. Masa wanted 100 times that amount. He needed a backer with pockets deep enough to match his cosmic ambitions. He found his target in the sovereign wealth funds of the Middle East, specifically Saudi Arabia's Public Investment Fund. In October 2016, Masa landed in Riyadh for a private audience with the newly powerful Crown Prince, Mohammed bin Salman. The prince wanted to diversify his nation's oil wealth. Masa promised him the future. Masa looked at the crown prince and said, "I am going to give you a gift of $1 trillion. You invest 45 billion and I will make it a trillion." The pitch took exactly 45 minutes. Mohammed bin Salman agreed to anchor the fund with $45 billion, establishing the foundation of the legendary SoftBank Vision Fund. Masa quickly gathered another $15 billion from Abu Dhabi's Mubadala and added SoftBank's own cash. By May 2017, the Vision Fund closed at a staggering $98.6 billion. This was not just a fund, it was a financial superweapon. It was larger than all other venture capital funds combined, ready to flood the tech ecosystem with unprecedented liquidity. But Masa's new empire had a fatal flaw built into its very foundation. How could any single human safely deploy $100 billion without inflating the market into a catastrophic bubble? Masa did not care about risk. He had a 300-year vision for SoftBank, believing that artificial intelligence and biotechnology would fuse, and he wanted to own every single gateway to that future. He began traveling the world like a financial conqueror, summoning the hottest tech founders to Tokyo to pitch him in his 26th-floor boardroom in Shiado. His investment style was terrifyingly simple. He would look at a startup, double or triple their requested funding, and demand they grow 10 times faster. If a founder hesitated to take his money, Masa would deliver a brutal ultimatum: "Take my billions, or I will hand them to your direct competitor and put you out of business." He did exactly this to Didi Chuxing in China, threatening to fund their competitor until their founder, Cheng Wai, was forced to accept a massive $5 billion investment. He did it to Uber, forcing them to accept a multi-billion-dollar investment or watch him fund their rival Lyft into a dominant market position. This was weaponized capital. Masa was not trying to identify the best business model. He was trying to brute force monopolies by outspending everyone else on Earth. The strategy created a global tech gold rush, with startups burning billions of dollars on customer acquisition to show the exponential growth Masa demanded. Silicon Valley fell in love with SoftBank's checkbook, but warning signs were beginning to blink red in Tokyo and Riyadh. How long could this synthetic growth last? Masa suddenly had $100 billion to deploy, a mandate to conquer the world, and a ticking clock which led him straight into the arms of a barefoot, tequila-drinking salesman in New York. We enter the second phase of Masa's grand experiment, where the cracks in the facade would widen into a chasm. The salesman's name was Adam Neumann. Adam Neumann was the charismatic co-founder of WeWork, a company that leased office buildings, divided them into trendy shared spaces, and subleased them to freelancers. To traditional real estate analysts, WeWork was just a glorified landlord carrying billions in long-term lease liabilities. But Neumann claimed WeWork was a tech company that would elevate the world's consciousness. In December 2016, Masa visited WeWork's Chelsea headquarters. He was running late, giving Neumann a mere 12 minutes of his time before walking out. But Neumann's wild charisma was exactly what Masa's gut was looking for. As they walked to Masa's car, Masa pulled out his iPad and began sketching a deal. Masa scribbled a commitment for $4.4 billion on that tablet, telling Neumann to make WeWork 10 times bigger and crazier than his original plans. Masa asked Neumann, in a fight, who wins, the smart guy or the crazy guy? Neumann replied, the crazy guy. Masa smiled and said, "You are right, but you are not crazy enough." Armed with Masa's billions, Neumann went wild. WeWork signed massive commercial leases across the globe, buying up real estate at the top of the market while burning cash like a furnace. They bought a wave pool company, an indoor primary school called WeGrow, and spent $60 million on a luxurious private Gulfstream jet for Neumann's travel. To trace how financial structures secretly dictate global tech, make sure you are subscribed to Built and Broken. We track down the systemic forces that mainstream media ignores. But the Vision Fund was not just investing equity. Underneath the marketing was a structural trap. 40% of the Saudi and Abu Dhabi money was preferred debt, requiring a guaranteed 7% annual coupon. Masa was legally forced to pay $2.8 billion in hard cash to the Middle East every single year, regardless of whether his startups were actually profitable. How do you pay billions in real interest when your assets are unprofitable startup stocks? You inflate your own startup's valuations in subsequent funding rounds to show paper gains. SoftBank would invest in WeWork at a $20 billion valuation, then a year later invest more at a $47 billion valuation. On paper, the Vision Fund was generating massive profits. But these paper valuations were not real money. You cannot pay a Saudi sovereign wealth fund with WeWork stock options. The pressure to generate real cash was intense. Masa needed WeWork to go public so he could cash out. In August 2019, WeWork filed its S-1 document with the SEC, preparing for its highly anticipated IPO. The moment Wall Street analysts read the filing, the illusion shattered. The document revealed massive losses, bizarre corporate governance, and self-dealing by Neumann. Neumann had trademarked the word "we" and forced WeWork to buy it from him for $5.9 million. He had also leased properties he owned back to the company. Within 6 weeks, WeWork's proposed valuation collapsed from $47 billion to under $10 billion. Institutional investors refused to touch the IPO. The IPO was canceled. SoftBank was forced to step in with a multi-billion-dollar bailout just to save WeWork from immediate bankruptcy, taking over the failing business.
Neumann was pushed out, but he did not leave empty-handed. He walked away with a massive $1.7 billion package, while his employees faced complete financial ruin.
In late 2019, WeWork's IPO collapsed to zero, exposing the rot. But Masa's true nightmare wasn't Adam Neumann, it was the billions in hard cash he owed the Middle East every single year, regardless of whether his startups survived. We enter the final act, where the systemic errors of the Vision Fund detonated, leaving a trail of destruction that still echoes through global finance. The WeWork collapse was not an isolated incident. It was the first domino in a global chain reaction of overvalued tech companies hitting the harsh wall of reality. Masa's other major bets were also in deep trouble. Oyo Rooms, the Indian hotel aggregator that Masa had pumped billions into, was burning through capital with no path to profitability. Brandless, an e-commerce startup that received $240 million from SoftBank, shut down entirely in early 2020, becoming the first major Vision Fund portfolio company to die. Then, the COVID-19 pandemic struck the global economy. Ride-hailing companies like Uber and Didi saw their usage plunge overnight, threatening the core of Masa's transportation investments. Masa was forced to perform emergency surgery on SoftBank. He launched a massive $41 billion asset sale, selling down his prized possession, his stock in Alibaba, just to raise cash. He also announced plans to sell ARM, the British chip designer he bought in 2016 for $32 billion. But global regulators blocked the sale, trapping his capital. By 2022, rising interest rates forced a massive reevaluation of unprofitable growth stocks. The era of cheap money was officially over, and the Vision Fund was caught completely naked. In May 2023, SoftBank dropped a financial bomb on the market. The Vision Fund reported a catastrophic $32 billion annual loss for the fiscal year, the worst in company history. Masa stood before reporters and investors, bowing deeply in apology. He admitted his mistakes, stating he was ashamed of his past overconfidence and greed. The man who once claimed to see 300 years into the future was now forced to focus on surviving the next 12 months. The dream of $1 trillion fund was dead. Let us look at the timeline of this incredible rise and fall. It took less than a decade to build and break the largest pool of tech capital ever assembled. As of 2026, the original Vision Fund operates as a zombie portfolio, with Masa surviving only by desperately pivoting SoftBank's remaining narrative entirely to AI, and its stake in chipmaker ARM to mask the venture capital crater. Masa's legacy is now cemented. He was a visionary who saw the future of the internet, but his hubris led him to create the very bubble that almost destroyed his life's work. If Masa's 300-year vision was so perfect, why was he explicitly threatening to destroy founders who refused to take his money? Was the Vision Fund actually designed to build the future, or just to weaponize capital against anyone who stood in Masa's way? Masayoshi Son promised a 300-year vision of a utopian future, but in the end, his $100 billion simply subsidized a decade of cheap Uber rides, empty office space, and the greatest bonfire of venture capital the world will ever see. He copied a playbook written 20 years earlier by a man who never got caught. If you want to see how that original scheme was built, subscribe to Built and Broken and stay tuned for our next episode. Next time, how Adam Neumann convinced Silicon Valley to give him $350 million. Subscribe, you do not want to miss it.